Two software engineers graduate from the same university. They both land jobs at a top tech firm, earning an identical salary of $150,000. By age 40, one of them is a multimillionaire, on track to retire by 45. The other is $30,000 in credit card debt, stressed about their mortgage, and sees no way out. The difference wasn't their income. It was the trap one of them saw and the other fell into. You know the feeling. You get the promotion. You see that new, higher number on your paycheck, and you feel a rush of relief. You think, finally, I'll be able to get ahead. But then something strange happens. A few months go by, and that feeling of relief is gone. It's replaced by the same old, familiar knot in your stomach when you check your bank account. The money is coming in, but it's going out just as fast, if not faster. You have the nice car, the beautiful home in the good neighborhood, the vacations you post on Instagram. On paper, you're a success. In reality, you're running on a treadmill, one missed paycheck away from a financial disaster. This isn't a niche problem. According to a Lending Club report, a staggering 61% of all Americans are living paycheck to paycheck. The most shocking part? That number includes 30% of people earning over $250,000 a year. You are rich on paper, but broke in reality. This is the high-income poverty trap, a silent epidemic where perceived wealth masks financial fragility. But today, we are going to expose it. We're going to give you the 4 specific, unbreakable rules that separate the high earners who build real freedom from those who just build a bigger cage. And it starts with slaying the dragon that guards the gate. Rule number 1, slay the lifestyle inflation dragon. Every time you get a raise or a bonus, a powerful, ancient force awakens inside your brain. It's a dragon called lifestyle inflation. Its only mission is to make sure your spending rises to meet and often exceed your new income. This isn't a character flaw. It's a psychological phenomenon called the Hedonic Treadmill. Your brain is wired to quickly normalize new pleasures. That new car feels amazing for a month. Then it just becomes your car. That bigger apartment is a thrill to move into. Then it just becomes home. Your happiness level returns to its baseline, but your expenses are now permanently higher. And this dragon is fed by your environment. You get a promotion, so you feel you need to live in a neighborhood with other managers. Your new neighbors all drive luxury cars, so you feel the pull to upgrade from your Toyota. They talk about their vacations to Europe, and suddenly your trip to the national park feels inadequate. This is social comparison, and it is the jet fuel for lifestyle inflation. You're not just keeping up with the Joneses. You're in a financial arms race with people who are probably just as broke as you are. Here is how you slay the dragon. It's a simple rule. Your savings rate must increase faster than your income. Let's use concrete numbers. Say you earn $100,000 and you get a 10% raise. That's an extra $10,000 a year, or about $833 a month. The dragon whispers, new car payment, designer clothes, fancier restaurants. If you listen, you've lost. But what if you preemptively decide to allocate 70% of every future raise to your investments? You would take $583 of that new money and send it straight to your investment account automatically. You still get to enjoy the other $250 a month, so you feel the reward of your hard work. But you've put your future first. Let's contrast two people. Person A gets that $10,000 raise and immediately leases a new BMW. Their monthly payment goes up by $800. Person B gets the same raise. They keep their reliable Honda and invest that $800 a month instead. In 10 years, Person A has nothing to show for it but a history of lease payments. Person B, earning an average 8% return, has an extra $145,000 in their investment portfolio. Same raise, same income. One person fed the dragon, the other built a fortress. But simply fighting the urge to spend more isn't a complete strategy. You need an offensive plan. You have to actively fight a much more subtle enemy, which brings us to rule number 2. Rule number 2, master the pay yourself first mandate. For most people, the financial flow looks like this. Income comes in, then bills go out. Mortgage, car payment, utilities, groceries, restaurants, shopping. At the very end of the month, they look at whatever is left over and try to save it. This is a recipe for failure. It treats saving as an afterthought. It makes your future the last priority, getting only the scraps left behind by everything else. That's not saving. That's breaking even. True wealth builders completely invert this process. They pay themselves first. This isn't a suggestion. It is a mandate. It means your savings and investments are not a leftover. They are the single most important bill you pay every month. It gets paid before the mortgage, before the car payment, before Netflix, and you do it automatically. Here's the system. You decide on a percentage of your gross income you will save. Let's say it's 15%. If you earn $120,000 a year, that's $1,500 a month. You then set up an automatic transfer from your checking account to your investment account for $1,500 on the exact day your paycheck hits. You never even see that money. It's gone before you have a chance to spend it. The rest of the money in your account is what you have left to live on. You build your lifestyle around what remains, not the other way around. This simple action is the bedrock of wealth creation. Let's look at the numbers. A 30-year-old earning $150,000 a year decides to automate a 15% savings rate. That's $1,875 per month. By the time they are 55, assuming an average 8% market return, they will have over $2 million. That number isn't the result of some risky stock pick, a crypto lottery ticket, or some complex financial engineering. It's the inevitable outcome of a simple, unbreakable system executed with relentless consistency. Now let's contrast this with person A, who has the same income. They try to save what's left. Some months, after a big vacation or holiday shopping, that amount is zero. Other months, maybe they manage to save $1,000. Their savings are random, emotional, and inconsistent. After 25 years, they might have a portfolio worth a couple $100,000, if they're lucky. Person B, the automator, is a multimillionaire. Same income, different system. Remember that feeling of dread at the end of the month, trying to scrape together some savings? Automation kills that feeling forever. It removes willpower, discipline, and emotion from the equation. It puts your wealth building on autopilot. Now you might be thinking, $1,875 a month? My expenses are just too high for that. That's exactly what the high-income poverty trap wants you to believe. Rule number 3 is how you shatter that illusion for good. Rule number 3, calculate your true hourly wage. Your 6-figure salary is a lie. It's a vanity metric designed to make you feel rich while obscuring the true cost of your life. The only number that matters is what you actually earn per hour after you subtract the hidden costs of your job. This concept, popularized by the book Your Money or Your Life, is a weapon against mindless consumerism. Here's how you do it. First, take your monthly after-tax income. Now, start subtracting all the money you spend just to be able to do your job. Your commute, whether it's gas and car maintenance or a train pass. The expensive lunches you buy because you're too tired to pack one. The professional wardrobe you have to maintain. The after-work drinks you need to de-stress. The daycare you pay for. the lavish vacation you feel you deserve just to recover from burnout. Be brutally honest. Now, add up all the hours you dedicate to this job. Don't just count the 9 to 5. Add your commute time both ways. Add the extra hour each night you spend checking emails from your couch. Add the time you spend on Sunday just dreading Monday. This is the total time you are sacrificing. Finally, divide your real monthly income by your real monthly hours. The result is your true hourly wage, and it is almost always horrifyingly lower than you think. Let's take an example. Someone earning $120,000 a year thinks they make about $58 per hour. But let's do the math. After taxes, their take-home is around $7,000 a month. They spend $400 on gas for their commute, $300 on work lunches, another $200 on dry cleaning and work clothes. So their real income is $6,100. They work 40 hours a week, but they also have a 90-minute round-trip commute each day and spend about an hour decompressing at night. Their real-time commitment isn't 160 hours a month. It's closer to 260. Their true hourly wage is not $58. It's $6,100 divided by 260 hours. It's $23 an hour. Once you know this number, it changes every single financial decision you make. That $150 dinner out isn't a small indulgence. It's almost 7 hours of your life energy that you can never get back. That new $1,200 phone isn't just a phone. It's 52 hours of your freedom. You're trading a piece of your life. Is that gadget, that meal, that piece of clothing worth it? Sometimes it might be, but now it's a conscious choice, not a mindless habit. This reframes your spending. But how do you know if you're actually on track to build real wealth? There's a simple formula for that, and it's the foundation of rule number 4. It's how the truly wealthy measure their progress, and it has nothing to do with their income or what they own. Rule number 4, obey the Millionaire formula. For decades, society has measured financial success with the wrong ruler. We look at income, job titles, house size, and car model. These are all symbols of consumption, not wealth. True wealth is not what you spend, it's what you keep. It's your net worth, your assets minus your liabilities. And there is a simple, powerful formula from the classic book, The Millionaire Next Door, that tells you exactly where you stand. The formula is this: take your age, multiply it by your annual pre-tax household income, and divide the result by 10. The number you get is your expected net worth for someone in your age and income bracket. Age times annual income over 10 equals expected net worth. Let's run an example. We have a 40-year-old doctor who earns $300,000 a year. We multiply 40 by 300,000 to get 12 million. We divide that by 10. Her expected net worth should be $1.2 million. This formula creates 2 categories of people. If your actual net worth is double your expected number, you are a prodigious accumulator of wealth, or a PAW. You are a master at converting income into wealth. If your actual net worth is half or less of your expected number, you are an under-accumulator of wealth, or a UAW. You might look rich, but you are failing at the game of building real financial independence. This is the only report card that matters. Let's look at 2 45-year-old lawyers, both earning $250,000 a year. Their expected net worth is 45 times 250,000 divided by 10, which equals $1,125,000. Lawyer A lives in a massive house with a huge mortgage, drives a brand new Porsche, and takes extravagant holidays. Their net worth is $400,000, mostly tied up in home equity. They are a classic UAW, deep in the high-income poverty trap. Lawyer B lives in a more modest home, drives a 5-year-old Lexus, and invests aggressively. Their net worth is $2.5 million. They are a paw. On the street, Lawyer A looks much richer. But in reality, Lawyer B has the power, the security, and the freedom. So I want you to do this right now. Pause the video if you have to. Calculate your number. What is your expected net worth? And where are you in relation to it? This number is your truth. It cuts through the noise of social media and the pressure to keep up. It tells you if your high income is actually working for you or if you are just working for it. The high income poverty trap is so dangerous because it feels like success. It looks like success. It comes with the car, the house, and the admiration of others. But it's a golden cage, keeping you chained to a job you may not even like, just to fund a lifestyle that doesn't build real freedom. The choice is yours. You can keep playing the game of looking rich, running faster and faster on the treadmill, trading your precious life energy for things that rust, rot, and depreciate. Or you can use these 4 rules. 1. Slay the lifestyle inflation dragon by saving more as you earn more. 2. Master the pay yourself first mandate through automation. 3. Calculate your true hourly wage to make conscious spending decisions. And 4. Obey the Millionaire formula and focus on your net worth, not your income. 10 years from now, you will arrive at a destination. The question is, will it be one you chose or one you just drifted into? Your future self will either thank you for the choices you make today, or they will look back and wonder where it all went. If this video changed the way you think about your money, subscribe to the channel. We're building a community of people who are choosing to build real wealth, not just the appearance of it. Click